Welcome everyone to Vested Interest. This is Shane, and before we get into the video, I'd like to take a moment to thank everyone who's taken the time to watch, comment, and like the videos, and a special thank you to those who subscribe to the channel. I really do appreciate it. Over 950 subscribers now, and the channel continues to grow because of people like you. Now, for those of you who may be stopping by for the first time, on this channel we focus on dividend growth investing. It's not rocket science. In my opinion, the best way to do anything, keep it as simple as possible. So it really boils down to consistently investing, dollar cost averaging on a weekly basis into dividend growth stocks and growing companies with positive cash flow that have enough free cash flow to cover the dividend with a high return on their invested capital. I do a dollar cost average approach, consistently investing into the portfolio on a weekly basis. I also do larger purchases if I get a bonus or I do a side job, something like that. I cover all my investments into the portfolio on a weekly basis. Every Sunday morning, I do a portfolio update, so make sure you hit that notification bell down below so you can tune back into those. I don't have anything to pay for. There is no paid Patreon. I don't have a paywall or other sites I'm going to send to you. I'm not trying to sell you any courses. And on this video, we're going to take a look at 4 stocks to potentially buy near or at 52-week lows. Now, before we get into the video, if you would like to help me out, because I don't have a paid Patreon, I count on you all helping me out by doing a few things. If you could hit that thumbs up button down below if you find any value in the content. Make sure you're subscribed to the channel. Join us on this journey to financial freedom. Join the Vested Interest community. Hit that notification bell so you're notified whenever we put out any new content. Again, not only this series, I do this one sporadically whenever I see some companies that I'm interested at or near 52-week lows. I also do a stock pick of the day video series Monday through Thursday when the market is open. I do portfolio updates again every Sunday morning. So again, make sure you hit that notification bell so you're notified whenever we put out any new content. Drop a comment down below. Let me know what you are watching right now. What companies at or near 52-week lows are you adding? Are you watching? Maybe you have some that you're trimming out of your portfolio that no longer meet your investing criteria. Go ahead and drop all those comments down below, or if you have any questions for me as well. And now that we've taken the time to do that, and really appreciate everyone who has done that, let's jump back into the video. First up on the list, we are going to take a look at this. This is the only one out of the 4 that is actually in my portfolio. This is Vale, ticker VALE. This is out of the material sector. This is a mining company out of Brazil. Now, all of the numbers that we pulled up are going to be as of the close of business on Friday. So they closed out the week at $11.26, and Friday would have been June 14th. This video will come out to you on June 15th. So closed out the week at $11.26. It looks like in the after hours they were up slightly, up to $11.31. This company has a market cap of $48.20 billion. EPS is 1.83, $1.83. Price to earnings ratio currently is $6.21, though their forward PE is a little lower than that at $4.98. They have a $1.42 dividend. They are a semi-annual payer. Typically, they pay out 2 times a year with a pretty high dividend yield right now at 12.6%. Now, their 52-week range as low as $11.07, as high as $16.08. So they are pretty close to their 52-week low here. They have a beta of 0.94, so they are just slightly less volatile than the overall market. Analysts call this one a potential buy. They have a price target of $16.73, so they see it setting a new 52-week high here, potentially over the next year with a possible 48.58% upside. Earnings date coming up in July 25th here. Now you can see that volatility with a 0.94 beta. You can see that volatility, right? So you might be able to use this volatility, which is what I've been doing, to try to get this one as cheap as possible. I've been buying this in the $12, $11 range. I think my cost basis is right at $13.30, something like that. So again, this is the only one of the 4 that's in my portfolio. I am adding right now, not a lot, but I am nibbling pretty much every week on this one, 2, 3, 4 shares whenever I have a little bit of extra funds. Usually I do my regular buys, and then whatever I have left, I'll throw in here. Now let's jump over and look at dividend yield theory. To do that, we look at their 5-year dividend yield average of $3.11, or 3.11%, I mean. 5-year dividend yield average of 3.11%. We compare it to its current. Now this is a little off. They say 15.49 here. Over here it said 12.60. Either way, according to dividend yield theory, this one is potentially undervalued. They have a payout ratio of 77.69. Now this is getting up there a little bit. I like 75% or lower, so this one is one that is a little higher on the payout ratio. Now this information was from Yahoo Finance. And stock analysis, a little mixed stock analysis would be the chart. Yahoo Finance is this one. same thing here, Stock Analysis, and then Yahoo Finance. So it's a little bit of a mix between the two. Now, when I looked at stockanalysis.com, they had the payout ratio right around 75%. So it's still up there on the high side. It's getting a little higher than what I like it. Anything over 75, you have to start wondering, is the dividend safe? Are there potential dividend cuts coming? Are they going to pause the dividend? So I like 75% or less. So this one is starting to get up there a little bit on the high side. Now, ex-dividend date, as we said, was March 12th. They did pay out on the 26th. And typically they have another payout here towards the end of the year, usually around September, October timeframe. So again, that one will be coming up here shortly if they do the second payout. Sometimes they only do the one, but typically they are a semi-annual payer. Return on equity and return on invested capital, I like 10% or better for these numbers. This tells you how efficiently the company is paying funds back into itself, whether that's making acquisitions, whether that's reinvesting back into the company, doing, in this case, opening more mines, or expanding existing mines, buying new equipment, that sort of thing. Now, their return on equity is 21.2%. Return on invested capital sitting at 16.77%, so above the 10% I look for there. We're going to jump down and look at free cash flow. We want growing free cash flow over time because typically if a company has growing free cash flow, they have growing dividends to go along with it. Going back to 2021, which was a very good year for them, $20.6 billion here. 2022, bit of a drop down to 6. 2023, up to 7.2. And this is the trailing 12 months. That's what TTM stands for. So it's basically the first 6 months of this year and the last 6 months of last year. So it does overlap a little bit of 2023. They're at 6.9 billion so far, and repurchase of capital shares. They are repurchasing shares pretty aggressively over the last 4 years. Obviously, 2021 and 2022 were very good, and 2023 and so far 2.7 billion. So I like that they're repurchasing shares, especially whenever they are cheap, like they are now, in my opinion, down here in the $11 range. So hopefully they're doing that aggressively right now. We're going to jump over to strictlystockanalysis.com. Right here is where I pulled this information, and we're going to look at some information out of their balance sheet and income statement that I like to look at. See if you can see here, right? And we've added a little bit to this slide just to give you more of an idea of the metrics that I look at here. So you can see revenue, and again, 2019, 2020, 21, very good. It has cooled off a bit, and mining companies, just the material sector in general, is cyclical. So you can see that cyclicality right here. So they have cooled off a little bit over the last several years, kind of evened out here in this 41.78 billion range in revenue. Same thing with profit margins, right? You can see that cyclicality here, really nice build up from 2019 to 2021 to 2022, and they've cooled off a little bit here in 2023, down to 19.11%. Still very good profit margins. EBITDA follows profit margins typically, so very similar chart here that you can see, and they've cooled off right about 12.49 billion. Total assets, it's pretty flat, so I like to see that, and maybe up slightly from where it was down in 2021 and 2022 here. Definitely up from where they were in 2022, 94.19 billion. Total debt has come down a little bit, up from 2022, but pretty flat from where it was with 2021 at 21.8 billion. And what I want to compare total assets to is total liabilities here. So you're at 94.19 billion in assets currently, and liabilities at 53.2. So almost twice the assets over liabilities, which is a very good ratio here. You always want to have more assets and liabilities. If they did get into trouble, that means they could sell off some assets, cover their liabilities, and still be a functioning company, right? That's what that means. And you want to see kind of reduced debt. What you don't want to see is debt spike, right? You don't want to see a huge spike up in debt or debt increasing. Like if this debt was going on a vertical up and to the right, that would be a bad sign. So they're keeping their debt under control. They have more assets than liabilities. And the last one I like to look at is, well, not the last one, but another one that I find is pretty important is their shares outstanding. You want it either staying flat or decreasing slightly, which is what you see here. There's a lot of flat here and then decreasing shares over the last couple of years at 4.76 billion. Last thing we'll look at here, again, payout ratio 77%. Again, getting a little high. I like 75% or under. They say their dividend growth is 29.72. That doesn't really match the math here, but they're sporadic on their payouts, so I can see how they get that. Usually one payout, I think it's the one in the March payout, is higher than the one later in the year, so that may be what they're looking at. But that is not definitely accurate because they don't pay a consistently growing dividend. It goes up and down based on the price of metals. Buyback yield is positive, shareholder yield at 13.8%, which is very high. That's very good. And their March payout was 54 cents, which you'd have to do the conversion. because obviously Brazil doesn't use the American dollar. But Vale is the first one on the list here that I am at, and it is in my portfolio, and I am adding to the position right now. Now, the next one on my list is Polaris. This one is out of the consumer discretionary sector, ticker PII. Again, closed out the week at $77.05, was up slightly in the after hours there at $77.49. Market cap of $4.35 billion. So this is a small cap company here. They have an earnings per share sitting at $6.82, very nice. Current price to earnings ratio, PE ratio $11.30. Forward PE even lower than that at 8.92. So this is starting to look very attractive, right? Just based on the PE with an EPS that would almost match their forward PE. That's very nice to see. They do have a $2.64 dividend annual payout. They do pay out quarterly. So this, unlike Vale, this one pays out 4 times a year. Ex-dividend date June 3rd, and they pay out on the 17th. So next week, they will be paying out their dividends. So kudos to those out there who own Polaris. You'll be getting your dividend next week. And that also means if you were to buy them now, you'd have to wait a couple months to get that next dividend. Now, their 52-week range as low as $75.54, as high as $138.49. So they are right up against their 52-week low. Not much further to go before they set a new 52-week low if they were to continue to drop. Analysts do call this a hold. I skipped over beta of 1.56. So they are more volatile than the overall market, right? The market being 1, anything under 1 being low volatility, lower volatility, anything over 1 being more volatility. So this one is more volatile than the overall market. But that means you may be able to use that volatility and be buying on the lows, right? Do your discounted cash flow analysis, figure out a cost you're willing to pay, and then whenever it drops below that, you take that volatility and use it to your advantage and buy below your cost basis or where you want to set that price target. Again, analysts do call this one a hold, and that may be because they think we're entering a recession or things are slowing down. People typically, whenever we enter recessions or when things slow down, they don't buy discretionary purchases like side-by-sides or motorcycles, stuff like that, which is what Polaris sells. They do have a price target of $106.81 with a potential 38.62% upside. So, again, might be one worth throwing on your watch list, see how things shake out over the next couple quarters. I like to buy whenever they're low, right at their 52-week lows, and then ride that upcycle. Earnings date July 23rd, so tune back in July if you'd like to watch earnings dates or earnings reports. We're also going to take a look at dividend yield theory here. We look at their 5-year dividend yield average of 2.5%. We compare it to their forward, current 3.4 or forward 3.4, same number. And since it is higher, that speaks to undervaluation, at least according to dividend yield theory. Now, this payout ratio is very low, 38.21%, so that's very safe. That means they have a lot of room to increase that dividend over time. They're more than covering the payout. They can still pay down debt. They can reinvest back into the company, make acquisitions, buy back shares, all the things that companies do with free cash flow, and pay you and I dividends. Return on equity, again, I like 10% or better. Their return on equity is 29.3%, very good, and the return on invested capital, 13.67, also a very good number. We're going to jump down and look at free cash flow here as well. 2021, you can see $10.9 million. 2022 was a very good year, $202 million. 2023, even more, $5.13 million. And the trailing 12 months so far, $305 million. And same thing, they are repurchasing their shares, taking advantage of these lows here. Hopefully they're buying a significant tranche right now. But 2021 and 2022 was a very high years for repurchase of their shares. Looks like they cooled off a little bit in 2023 and maybe cooling off here in 2024. Same thing, we're going to run through some of the balance sheet here, income statement. Revenue, you can see here, a little better than Vale, nice steady growth, currently at $8.93 billion in revenue. So revenue is growing, right? It has been growing since 2020, but same thing. This type of company, it has a bit of cyclicality. You can see that cyclicality right there. 2019 dropped in 2020, but then has been steadily growing since. But if we enter into a recession, you might see it either flatten out or possibly pull back a little bit, right? Same thing with profit margins, bit of cyclicality here, but pretty nice profit margins here. They're not at their highs like they were back here in 2021, but they are not at their lows like they were here in 2020 either. So 5.63% profit margin. EBITDA kind of follows the profits margin again. You can see here, $1.00 billion. Total assets, their assets are a nice steady increase up and to the right, $5.52 billion. Shares outstanding here, same thing. Nice steady decrease. Looks like they actually flattened out 2019 to 2021, maybe slightly down from 2020 to 2021, and then have been decreasing the last several years. Same thing, we want to compare total assets to total liabilities. Now this one is a little bit closer of a margin here. 5.52 billion in assets, 4.09 billion in liabilities. So I like to see more of a separation here between the two. This is getting a little close for me, but their debt is under control, right? They're keeping their debt down to 1.91 billion. Their assets plus their debts would be a little bit more than their liability. So it's good that their free cash flow is so low, because if they were to have trouble, that's what they'd do. They would stop paying that dividend to help offset some of this debt. Hopefully they're continuing to pay down debt. The repurchase of shares is going to help out with that over the long term. Again, quarterly payout ratio of 38.7%, dividend growth of 1.55%. So slow growth in dividend growth, even though it is so low. And it's probably because their assets and liabilities are so close and trying to get some of that debt under control. And they're taking advantage of buybacks right now over dividend growth is what it really looks like. 26 years of dividend growth, even though it's slow. Buyback yield of 1.55%, shareholder yield of 4.98%. So both positive, and their last dividend, June 3rd, the one that's going to pay out on the 17th, is 66 cents. Next up on our list, and we covered this in the stock pick of the day series here last week, Nestle. This is a foreign company here, so there are going to be some tax implications potentially. Nestle, ticker NSRGY, is out of the consumer staples sector. $106.71 they closed out the week at. They did not have anything in the after hours, or at least they don't list it. And this one being a foreign company, they don't have some of the other stuff like the analyst target. There were no analysts that take a look at this, but we'll run through the numbers we do have. Market cap of $274.33 billion. This is a large cap company here. EPS $4.74 per share. Price to earnings ratio current $22.63 per share. Lower forward $18.32 per share. Dividend is sitting at $3.41. They are a quarterly payer. Nice starting dividend yield of 3.19%. Ex-dividend date was April 22nd, and they paid out May 31st. So if you were to buy them now, you would be in line for their next dividend, but you're going to be waiting a couple months to get it. 52-week range as low as $99.04, as high as $125.41. So not right against their 52-week low, but still pretty close, much closer than their 52-week high, which is why I added it here. Now they do have the beta listed, so they 0.31. They are less volatile than the overall market. They do not have an analyst estimate. They did not have a price target, and they do not report their, or at least according to a stock analysis where I pulled this, they do not have a earnings date listed. So let's take a look at dividend yield theory here on this one. 5-year dividend yield average of 2.53%, current 3.07%. Since it is higher, that speaks to undervaluation, at least according to dividend yield theory. Payout ratio is 70.28. So another one that is kind of getting on the high side, but I like 75% or less, so this would be under what I'm looking for there. But again, you want to watch that payout ratio. If they start getting above 75%, it's what you want to start looking at, worry about whether or not the dividend is safe. Does it give them enough of a cushion to continue to pay down debt, make acquisitions, buy back shares, increase that dividend over time? Now, return on equity and return on invested capital, 31.63% for return on equity, 3 times the 10% I look for. Very good number here. Return on invested capital, 4.28%. Again, above the 10% I'm looking for there. Let's look at free cash flow. 2021, $8.5 billion in free cash flow. 2022 looks like it dropped to 6.5. 2023 back up to 9.7. And so far, the trailing 12 months is 9.738, almost the same exact number here that you'll see, which is why I don't really like to use trailing 12 months, because again, it's so far what we have in 2024 plus 6 months of what we have in 2023. So it's an overlap, but it's what we have, so we're going to use it. Repayment of debt here. They are repaying their debt, but they are not repurchasing their shares, or at least that I could find. So again, we're going to look at Nestle's, some of the metrics here on their balance sheet and income statement here. We're going to take a look at revenue. You can see here pretty steady growth here on their revenue, currently at $93.35 billion, though it looks like it might be a little flat from 2023 to 2022. Profit margin sitting at 12.33%. Again, not up against their high, but growing from last year to 2022 to 2023. EBITDA, nice steady growth in their EBITDA, $19.52 billion. Total assets currently sit at 126.55 billion. Shares outstanding, again, slight decrease every year, so they must be doing some share buybacks. 2.65 billion here currently in their shares outstanding. Now again, we want to take a look at their assets over liabilities. So liabilities currently sit at 90.168 with assets at 126.55 billion. So very nice spread there. Not quite the what we saw with Vale, where it's almost twice the assets over liabilities, but not as close of a spread as we saw with Polaris either. So pretty good there. Now this is one where total debt is doing the opposite of a couple of the others that we saw. They are actually increasing debt. So we don't like to see that. I'd like to see debt going down on this one. That's one of the negatives that I did notice with this company. So you want to keep this, though it looks like it's almost flat from 2022 to 2023, especially with increased rates right now. We want debt to be going down. Now, they are an annual payer. They do only pay out once a year. Payout ratio we saw was in the 70s, 71.78 according to stockanalysis.com. Dividend growth is nice though at low single digits, 6.97. 1 year's of dividend growth, which actually they had more than that. I don't know why they're only saying 1 year. They had more than 1 year of growth. Buyback yield of 2.25%, shareholder yield of 5.45%. So that's Nestle. Last one on our list is Schlumberger Limited, ticker SLB. This is out of the energy sector, and they provide equipment to companies like Chevron, to Mobil, ExxonMobil, the oil drillers out there. They're providing the equipment that does that drilling and oil exploration. They are down to $43 per share as of the close of business, actually down a little bit more in the after hours there on Friday. Market cap of $61.46 billion. EPS is $3.01 per share. Price to earnings is at $14.29. Again, lower forward PE at $11.63. $1.10 dividend, and that's their annual payout. They are quarterly payers, so divide by 4, though we'll see that here in a little bit. Nice starting dividend yield of 2.56%. Ex-dividend date June 5th. They are going to pay out July 11th. 52-week range as low as $42.61, as high as $62.12. So they are right up against their 52-week low here. A beta of 1.58. So they are more volatile than the overall market. Analysts call this one a strong buy. They have a price target of $68.76 with a potential of 59.91% in price appreciation over the next calendar year. So that's very aggressive. That's a very good potential return there. If it happened to work out that way, that would be very nice. This is not one that I'm buying right now, but it is on my watch list. It is one that's really caught my eye recently. Earnings date July 19th. Now we're going to take a look at dividend yield theory for this one. We look at their 5-year dividend yield average of 3.21%. Their current dividend 2.56. Over here forward 2.56. Now since this is lower, that actually speaks to overvaluation on this one. So even though it is right up against their 52-week low, at least according to dividend yield theory, this one is potentially still overvalued. Another one with a very low payout ratio, 34.17%, so it gives them a lot of room to increase that dividend over time. And I will say, I did go back and look at Schlumberger's history. They did have a dividend cut, I believe it was in 2020. So they have been raising their dividend for the past several years, but they recently had a dividend cut a few years back. Return on equity sitting at 22%, so twice what I'm looking for there. Return on invested capital at 13.8%. Again, very good numbers here. 2021, you can see their free cash flow was at $3.4 billion. 2022, bit of a drop down to $2 billion. 2023, $4.5 billion. And trailing 12 months, 4.576. Repurchase, looks like they are repurchasing shares, or they were in 2023. They've continued that into 2024. So that may have been part of the reason that they cut that dividend. Maybe they're going to focus more on repurchasing their own shares, which I do like when companies do that. It pulls shares out of the market. It makes you more of a shareholder over time. Same thing here. We're going to look at Schlumberger's some metrics here out of their balance sheet, income statement, revenue. And this may have been the reason, right? They had decreasing revenue coming to 2019 to 2020 into 2021. So right back in here is whenever they decided to cut that dividend. And I'm assuming it was because they had decreasing revenue. Since that cut, though, they've turned it around and they've had increasing revenue, which is nice to see. $33.14 billion currently. Same thing. Their profit margins were decreasing here. I'm assuming that's part of the reason they hit that dividend cut, trying to get their cash flow under control, trying to get their balance sheet under control here. And since then, they've had growing margins at currently at 12.68%. Same thing with their EBITDA. So you can see here, right? See how these were negative, and then they cut that dividend, and since then they've had better showing. Total assets, same thing. They may have even sold off some assets here to try to get under control back here. But since 2021, they've had growing assets up to 47.96 billion. Shares outstanding for them is just flat, right? They're not really pulling any out of the market, but they're not diluting you as a shareholder either. Now we're going to look at total assets compared to total liabilities. Same thing. I do like this. They've had pretty steady decreasing liabilities, and their current liabilities sitting at 26.6 billion compared to 47.96 billion in total assets. So almost twice the total assets compared to total liabilities. I like that. And their debt is decreasing, right? Again, back here in 2020, they were pretty high in their debt. They've since started paying down that debt, and I'm assuming that's part of the reason they cut that dividend, again, to help get their debt under control, to help get their overall numbers under control, which I don't mind a company doing that if they start using the capital the way they should be. So since 2020, they've had a bit of a turnaround here, and that would still be the way you'd look at Schlumberger. This is still maybe a potential turnaround play. Now that they've got their numbers under control, can they continue this revenue growth? Can they continue to see better margins? Can they continue to increase their assets, decrease their liabilities, decrease their debt, and hopefully here start pulling some of these shares out of the market, though they're not doing that quite yet. Again, dividend yield of 2.56. Annual dividend $1.10. Ex-dividend date was June 5th. Quarterly payout ratio 36.5%. Dividend yield of 23, or dividend growth of 23.53%. That's not quite right. I did the math. It's really only in the teens. They do show 2 years dividend growth, which is right, and I think that dividend growth there of 23.53% is accounting for from when they cut it a few years back. Dividend yield 0.07. Shareholder yield of 0.249. So last dividend paid out June 5th, or the one they're going to pay out here on July 11th, is going to be 27 cents and a fraction of a penny there per share. So Schlumberger is one that I really like now that they've kind of reassessed what they were doing back here in 2020 and 2021, and the numbers start looking a little better. This is one that's on my watch list. I am watching it to see if it bounces off its 52-week low or if it's going to break through that 52-week low and set a new one. Well, that is it for this one. Let me know what companies at or near 52-week lows that you are watching, you are adding to your portfolio. What are you buying right now? Are you selling anything? Really love to hear from you. Drop all your comments down in the comment section down below. As always, appreciate you stopping by. If you haven't done so already, don't forget to show me some love. Hit that thumbs up, ring the notification bell. Most importantly, subscribe to the channel. Join us on this journey to financial freedom. I do personally read and respond to the comments. I'm always interested to read your questions, opinions, or suggestions for future topics. So drop them all down in the comment section below. And this is Shane signing off, wishing peace and prosperity to you and yours. And remember, financial security comes to those who take a vested interest. Hey, thanks for stopping by. Thanks for tuning in, and I hope you have a great weekend. I'm not a financial advisor. Nothing in this presentation should be considered financial advice. I'm only sharing my opinion and investing journey for educational and entertainment purposes. Investing involves risk. You can't lose money. You should never invest any amount you're not comfortable losing. Always do your own research. Invest based on your situation, circumstances, and select criteria, or seek the advice and counsel of a certified financial advisor.